You need to determine how much of the issues are inflicted by the company themselves. In other words, have they made mistakes, and how much of it are market. You then got to assume it's going to last a little bit longer than you think and perhaps be a little bit deeper. But if your strategy is working well, you're in the right market transitions, your customers are happy with you, you want to stay the course through it. However, you've got to separate the symptoms from the underlying issues. I'm very concerned about the Fed putting on the brakes so consistently. What you do when you keep doing the right thing too long, like it was done during the 70s, probably does not work in today's times. So if you already have brakes being applied on the trade issues and some of the economies around the world, which, by the way, I agree that we've got to solve the issues with China in terms of the symptom being the trade imbalance, but really the practices there we need to address. I think the Fed's got to be very careful about continuing to do something that worked 30 years ago, but staying the course a little bit too long on it. In the long run, however, technology is going to do well.
I was going to say, it sounds like you are a believer, if not in the supply side theory, at least then in the productivity theory, that technology is going to allow us to grow while keeping inflation in check.
Carl, you worded it very well. The productivity from artificial intelligence, I have two major companies on that. One of them has gone from $1 million year growth last year to over 80 million already this year. Artificial intelligence will completely change the productivity, the outcomes, etc. So I think as you get productivity going well, we've got to be careful not to apply the brakes too quickly in other areas. But that's also why tech is the place to be over the next decade. There will be a rotation, however. Some companies that led 10 years ago clearly are not leaders today. Some of the leaders today will not be the leaders 10 years from now. But the companies you talked about today, if you were to do a portfolio across to Microsoft, a Apple, a Netflix, a Amazon, etc., I think they'll be the players that you will do well in over the next decade. It's the fun thing about being a private investor. All my investments are where is the stock going to be 1 and 3 years out. I don't have to worry about quarterly volatility, and that's actually fun from a leadership perspective.
That's interesting you just said that, John, because we do have, coming into next year, quite a pipeline full of prospective IPOs out of the tech community, be it Uber, possibly, Airbnb, possibly, the list goes on. Given the fact that we are seeing all this volatility and we are seeing this sell-off in recent weeks in tech, do you think that's going to affect the IPO pipeline?
Well, I think it will affect the pipeline a little bit because if technology is on a very positive trend, first, the IPO prices will be higher and more will come in. But what you're seeing is a pretty good flow of IPOs. You're looking at 230 IPOs on the NASDAQ and the New York Stock Exchange this year being the most likely. But I think the number needs to be 3 to 5 years from now, more in the 400 to 700 range, like it was in the 90s, to create the jobs and to keep the economy going at the level that we want, per Carl's comment earlier about the tremendous productivity that technology, artificial intelligence, machine learning, digitization is going to drive. So I think we've got to get these startups going at a faster pace, not a slower pace.